All right, good morning, everybody. We are halfway through the week, yeah? Good start. Kind of a mixed bag out there. Hong Kong is flat. The NASDAQ also flat. Small caps up the most, getting close to that 0.5% level. This isn't the same kind of run that we saw earlier this year, or even kind of late into last year, where the small caps would perform reasonably well in the overnight. Then we would get into the regular trading session, and the NASDAQ and small caps would kind of swap places. I don't think this is the same sort of situation, especially with the bleed yesterday in all of those software names. It's a whole new world out there for sure. And I don't think any of us can anticipate where it's all going to end up. Japan up more than 0.75%. UK almost 1.25. We are going to get some data today, but not as much as we would like due to the government shutdown. We're going to start losing more and more data. And then, of course, it's going to take a long time to get caught back up again when we do get the government back up and running. It sounds promising, like they are close to getting something done, but don't count those chickens before they hatch. It's easy to dismiss energy, compared to 15, 20 years ago, but it's still worth keeping on your radar, especially when it comes to the collar that the government really has around the price. So keep your eye on the Strategic Petroleum Reserves data, see what the government is doing on their end. It's just a good thing to keep track of, right? Crude oil inventories. Continue to keep our eye out for the market to reprice or to begin pricing these rate cuts. There's more and more conversation about Powell's replacement, this Warsh guy, and how he is such a puppet for the administration. And the market must not believe that, because if they did, they would be pricing in cuts. If this guy is just going to come in and just, perform the president's will, then we should be seeing cuts get priced in all the way across the curve. And that's not what we're seeing. It doesn't hurt to keep your eye on the numbers, though, especially say like yesterday when we had that sharp sell off and everybody was starting to freak out and was wondering, how bad it was going to get and whether we would see any sort of assistance, like a Fed put. It never got bad enough yesterday. I kept trying to reiterate this throughout the afternoon, but if you look left and price is still within the previous day's trading range, Well, then you didn't go anywhere. And it must not have been that bad if you're still inside of the previous day's range. Now, I'm just talking about the indexes. If you look at some software names, well, I mean, they kind of got kicked in the face. But from an index perspective, we didn't go that far, but we did go very swiftly, however far we did go, right? That I think is what really shook people the most yesterday. The rate of change in the price of the markets move. So we still have silver up again this morning, gold right behind it. I'll continue to argue that you need to be very careful in this situation. Sure, it's green. Yeah, it's pointed to the upside a little bit, but this lower chart down here, it's an hourly chart. You can see that, yeah, sure, we're up this morning. And yeah, we're poking outside of yesterday's range. Yay! But we are still well off the highs. We're not even back through the half yet. And it's very likely that this is a rally into resistance where we roll over, setting a lower high, and then we begin working our way down to set a new lower low. So, I wouldn't see this as a buy the dip opportunity at this point. So he signed the bill, right? Funded to September except for DHS, which is funded for 7 days. So what are they going to do about the Department of Homeland Security then? And they still got it just because he signed it. Is it done then? It's gone through the House, the Senate, it's done? Or he signed off, but they still need to get it through the House and the Senate? Cool, cool. It's done. All right. Well, that's really good news. We're mostly there then. That means we didn't lose too much data, right? Not like the last government shutdown where we were missing a lot of data and it took a long time to kind of get put back together again. The software complex is crashing. That was a big thing yesterday. The other part of it was private credit crashing as well. So we're looking at 97,000 in the overnight volume. That's above the decent volume, right? There was strong participation in the overnight hours. That's what we want to see. Really, I use that gauge for exactly that. What level of participation did we have? And if it's really low, then it's kind of a warning to me that perhaps we didn't have everybody participating last night. Could be that there was, a government that was closed for holidays or something like that. I am just the regular typical American, right, with my head in the sand. I don't pay attention to other countries' holidays. So rather than having to check every single day and every week if some other country has a holiday this week or not, I just look at that volume. If it's off, then I know to go check and see what nation perhaps wasn't here in the overnight. There's a great website for that, by the way, if you haven't heard me talk about this before. It's free, it doesn't cost you anything. It's called tradinghours So if you go to trading hours, you can see markets from around the world. It'll show you the ones that are open right now. You can click on it and you can read about their economic calendar, their holiday events. You can see their trading hours, when they open, when they close. So it's a really great website and it doesn't cost you anything, right? It's free. You can even get these calendars that you can add to your calendar. So, if you're using uh, one of the Google systems or the Microsoft systems, you just add it to that, and then, you just get notified of your own system. There's a very clear clock that lets you know if they're open or closed. Just, be mindful of the idea that, take our market for an example. Us futures traders can trade 23 hours a day in the US markets because, just because we're not quote open doesn't mean that we can't trade. And it's the same for other nations. When it comes to trading futures and commodities, treasuries, and FX markets, money can move 23 hours a day. All right, we're dancing around that zero gamma volatility trigger. We've got the 10, the 20, and the 3 all stacked up right here. Now, they're not as tightly compressed as I would like. I'd like to get that 10 down just a little bit more. But really, it's pretty darn close. So if we're looking for any sort of a move to the upside, that's just one structure that we have to get through. The thing is, we've been crossing through this level back and forth, right? So it's not that big of a deal. If it had been the first time that we were coming into contact with these, it would have more weight. But the bigger issue is where the half is. And of course, the big options level, 69.50. But you can see the half, 69.53. And you can see right where we're at now. So sure, it's the moving averages a little bit, kind of, but it's also just, that's the half, yeah? So we got to get through the half if we want to try to maintain this push to the upside. The markets have been doing a really good job defending this low, but that's a lot of work down here, right? See all this wicks. A lot of work to keep us above that 69.50 in the ES. And at some point, if price keeps coming down and checking this liquidity below us, the liquidity is going to move or it's going to run out. I guess another way to think of it would be, like say there's only so many pieces of pizza, right? You keep reaching in the box to grab a slice of pizza, and at some point you're going to reach in there and there isn't any more pizza left. The market keeps dipping down into this pool of liquidity. If it keeps doing that, there won't be any left. At which point, if it reaches down and there's nothing there, it's going to have to reach lower to find some liquidity. So we'll see how it goes. But, the clock is ticking. And how many more opportunities are we going to get? So what we want to see is to get back above this half, that 69.50 level, preferably get through the 7,000 level and get up through that 70.50 level. We need to get out of this box, right? Let's kind of just back out here for a moment. This box that we've been dealing with since last year, we need to get completely and definitively out of this box to the upside and then own that like a Busby, to where we've validated new support off of old resistance and we are firmly up here and out of this mess. A Busby would look something like this, where we've checked and tested a resistance multiple times. Then we come back down and validate it as a new support. So we got to get out of the box, but we want to be up here somewhere and own that as the new space, right? There's plenty of examples of this. If you want to look in the past, just scroll back where we had the market developing a strong wide range and it built it out for months before it finally got the push. So this does not have to turn negative. I know I had a few people talking to me in the last 2 weeks because I keep calling this a topping pattern, which I guess to them implied that we had to go down from there, but that isn't the case, right? You can have a topping pattern because it's just the top, right? There's no argument that we've ran up here and we are at the upper edge of this run. So a topping pattern. But we can go higher from there. Nothing says that we have to go down just because it's a topping pattern. Especially after we've built for months this structure. If we was to go down, as long as we stay within that 6,500 or 6,550, then we're just dancing in the lower half of this range. That's the 200 period daily moving average, basically. And that should make sense, right? If you're holding above the 200, then you're still in structure. All of this is the range. We're not bearish, to me, unless we can get underneath that 65.50. That would put us, out yonder. So the main thing is we're just looking for something to break. As for yesterday in the comment about, we didn't go anywhere. We had a big day. Then we just topped out and we had another big day, which put us right back down to where we were. And now we've run back up and we're kind of at Friday's close. So we haven't done anything all week. And if you look back at Friday, it was within Thursday's range. So I will continue to argue that yesterday wasn't some big, scary, bearish move when we haven't done a darn thing. Right? Yes, we went down, but we didn't go down very far. We just went down really fast. And that's what freaked people out. But when you're inside day in IX10, then we didn't go anywhere. So take a breath, relax. It's all good. We can reach the upper edge of the ADR today without getting an inside day breakout, but we can't hit the lower full ADR without getting an inside day breakout. As for the average daily range, right here, as you can see, it won't take much for us to hit either side. We've got a lot of volatility. Remember that volatility is a nerd word for movement. So we don't need volatility gauges. We can just look at price and see that it is making big moves. We're close to the upper edge, but just like yesterday, we don't have to hit it. We can just get close. It is more likely that we hit the line than it is for us to just get close and not hit it. But either way, we have to look at yesterday's price as a gauge for where we're going to go today. If we get to the upper ADR line early enough, we can go to the lower ADR line by the end of the day. And since we're closer to the upper one, that would make sense. But we've got a reasonably tight Globex range that we're working on here. If we break this Globex range without hitting that upper edge, then forget the upper edge. Focus on the lower edge. That'll line us up with yesterday's low. It's not perfect, right? But it'd be the same idea. 68.92 cog line or yesterday's low. That's the goal, right? Destination trading 101. You got to target, aim for that. Now, I had someone ask the other day about these targets. The idea isn't that you get in and you stay in for the whole run. You could, but that run could take hours. And I don't know about you, but I don't want to be in it for hours. It's the idea that if you know where it's going, then you can find opportunities to get in and get out, be nimble, get your points. And if you find another setup and we still haven't got there yet, then take another trade because we haven't got there yet. We're still working in the same direction. So you do you. You want to get in and hold it for 3 hours before it gets to the level, then do that. I don't. $69.50 is the half back of the RTH of yesterday. You can see that we've crossed that level multiple times in the overnight, so it doesn't have a lot of validity at this point. It's not support or resistance. It's more of just a gauge or a line in the sand for us to focus on from a bearish or bullish bias. If we're above that half, then we want to stay bullish and look for long opportunities. And if we're bearish, then we want to look for our short opportunities. If we can get through this ADR red line, then we want to target the ADR yellow line, 7011 cog line. But to get there, we've got a 92 cog line, and then we've got the roundy at 7,000. So there's multiple targets to the upside, plus the RTH open, and then the full high of yesterday, not just the RTH high. Level by level by level. The average daily range has expanded by 10 or 15 points in the last few days. These big moves will start to expand our average daily range wider and wider. It's another signal of bearishness, but we didn't have a high correlation coefficient yesterday. I know it sounds like big fancy words. The logic behind it is when we're really bearish, I mean like really bearish, everything's red. You don't have strong pockets of green in various sectors. You just have every single sector red, and we didn't have that yesterday. So we had a lower correlation coefficient. There's indicators that track that, by the way, like dispersion indexes and the core 3-month, right? Something like that. That's COR3M if you're looking on TradingView. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. We're underneath the weekly pivot point, and that is bearish. With all of that in mind, it might sound like I'm bearish, but I'm not. We're hovering at that level. We haven't really gone anywhere. We got a bit of a reciprocation move, right? How much we had above, we had below, at least just gauging it from this level. And here we are testing against that same weekly floor pivot again. So it just kind of argues, that we haven't done anything. Because of the wide moves, the S&R lines are going to be really far apart. And they're not helpful because of that, right? How far away they are. So sure, if we run all the way down and break yesterday's low and we continue to the downside, then 68.75 is the S1. And if we run to the upside, then we've got 70.11 cog line with an overshoot into 70.15. That's R1. That's not really helpful, right? They're just so far away. So they are there if we get a big push. Kind of makes you wonder how much juice the market has after this great expansion yesterday and Monday, right? Maybe it's got some gas left. It's possible. All right, I've highlighted this point of control for a while now. That's really the only one that we've got that offers a little bit of insight. We've run through these others and broke them enough that they don't have much to offer, right? So looking down below, that's really the only one we've got that has anything that might contribute to this. We're starting to fill out this lower area, so we're losing our classic P-shape profile. By the end of the week, we could have developed a second D shape. I know that looks like a B, but we don't use that letter in profiles. So it's either a double D or a triple D, but we don't use the B letter. So we've filled out the P, that's gone. We are perhaps even going to develop more of a classic distribution if we can get back up into this shallower zone. If we can fill that in. It is worth looking at how thin it gets through this zone. We can move through thin areas relatively quick, and there's no structure down there to help us out. So at this point, we're still within the value area. 69.32 cog line is the value area low, and there's not much to help us out with below that. So I'd run roundies. If we get underneath 69.32 cog line, then you've got 69.11, 6900, 68.92, and then 68.50. Ten-day, 30-minute volume profile in TPO. By the end of the day, unless we come down and break this low and put in a new low, this should be our new profile width, because we should be wiping these candles off by the end of the day today. So when we come in tomorrow, it should be a bit more narrow, but it's just a wee bit more narrow, right? We're not removing much from the equation at this point. The TPO is a lot cleaner than the volume profile right now. You can see that thin, shallow area that I was talking about. So if we start to break back down and getting into the lower levels of yesterday, it's thin. There's not a lot down there that's going to help us out, at least from previous price structure, right? All right, we took that VPOC off the table yesterday, cut through it. We didn't even really negotiate with it for very long. So we're done with that. We don't have a new one for today since we opened at that level and we cut through it last night multiple times. So no new VPOC there. We still have this old one, 68.53. So if we do break down below yesterday's low, then we've got Monday's low, and then we've got that 68.50 level down there with the VPOC 68.53. The distribution yesterday doesn't really have a lot to offer. We can see these large pockets and big volume shelves that are highlighting those pockets. The textbooks would tell you to carry forward these value area levels, value area high, value area low. Now, I don't generally do that. I've got enough pivots. I don't need those. But if we try to make a move to the upside, this value area high lines up with this high volume shelf here. And that 69.70 looks like it's going to be difficult to get through, to say the least, right? And the point of control from yesterday, 69.40. Well, 41 is an old cog line, right? We don't really use that one anymore. But back in the day, 41 was an old school line. It's also where we put in a lot of work last night, and it is basically our value low today. So it's worth keeping your eye on there. If we lose our Globex low, then we've got this shallow area. And that can get us down into that 69.11 really fast. So we should drop through this zone relatively easy, all things considered. We passed through there yesterday with barely a speed bump. And for this morning, just your classic distribution, no real tell here on either side. We didn't run into a bunch of sellers sitting up here. Buyers just got exhausted, so we don't really have a lot to lean on this morning. The weekly expected move is this range here. It's another argument that I was trying to make with people yesterday when they thought the S&P and the Nasdaq was making such big moves. This is the range for the week. Now, we've seen the market open on a Monday and run all the way to the edge of the weekly range in one day. Heck, we've opened on Sunday night, gapped up or down at one of those levels on a Sunday night open. So if you look at yesterday, we didn't go anywhere. We didn't even make it to the edge of the weekly expected move. We barely got outside of Monday's range to the upside. So again, the same argument. We didn't do anything yesterday. This is Thursday's range from last week. GTFO. We need to get out of that box. We are 0.5% above the 10-week. So, that fade yesterday brought us a lot closer to the 10. This isn't bearish or bullish. We're just hovering around that 10. We need to see what we're going to do with it. Each day that goes by, these moving averages move. Of course, that's a weekly, so we won't see the weekly 10 move until it prints a new level next week. But on the daily, we're seeing that move. The calculations from this week's moves will matter. So by Monday, however far we traveled from that 10 and then have that 10 move with its calculations, it's going to be a different number. At this point, we're not overbought, we're not oversold. We didn't move too far too fast, and it doesn't owe us any sort of mean reversion. That should make sense, right? Because we haven't gone anywhere. Just keep arguing that over and over. Don't look for any sort of mean reversion at this point because we didn't do anything. We are below the 10-day, but we've crossed through that level multiple times, and at this point, it is not support or resistance. See, we're just maintaining structure here. And when we're this close to the 10-day, volumes change a little bit on the options. The pace of the tape is a little different. The size of the trades. So if you're a quant nerd, you'll notice the changes. Otherwise, just keep your eye on price and look for that expansion to get beyond 0.5%. How far away we are from the 10-day, above and below, or below. So right now we're below it. We want to focus on getting back above. And for the distance that we could move, we can easily make a 1.5% move lower, and we would just barely be talking about how we are a bit oversold, right? But we would need to make a 1.5% move and then have the 10-day move for its daily calculations and still have that 1.5 distance after its move. So we got plenty of room to the downside. That basically equates to a 2% move to the downside, and we still wouldn't be oversold. Think about it from the center of a basketball court. If you're in the center of the court, you can go to either side, right? But if you're already on the edge of the basketball court at one goal, you really have nowhere to go but to the other goal. So if we were already heavily bearish or heavily bullish, there's nowhere to go except the other direction, right? So we're not overbought, we're not oversold, we're not overextended. It doesn't owe us anything, and we can make a 2% move really in either direction, and we still wouldn't be overbought or oversold at this point. Looking at what's down this morning, China, generic tech, chips, and more from there, but my benchmark is 0.5%, so I really don't want to count these. I count chips just because it's close enough. It's nearly at that 0.5%, but really it's not quite there yet. So we don't have a lot that's down this morning. If you look at the VIX, it was up more than 6% in a 5-day period. Now it's down just a little bit. The KWeb constituents, those China ADRs, Baba, Baidu, JD, PDD, all those guys, the KWeb group was down, what, 6.5, 6-ish. It's only adding to that by 1% this morning. Looking at what's up, gold's up 2.5, but it was down 15% in a 5-day period. For all we know, gold and silver are just getting a relief bounce, and that it's going to run into a resistance, right? Because that's what price does. Bounce on support, run into resistance, fall down, set a lower level, on and on. We'll know that that theory is wrong if we run all the way back up and break the previous high and set higher highs. That's how we'll know we're wrong. Solar's up, uranium, metals and mining, more uranium, nat gas, emerging markets, which is China. Again, we had that talk yesterday too. I pointed that out. So generally speaking, we just lump emerging markets in with China, right? Because it's got so much China stuff in it that really most of the time it moves like China moves. But yesterday and today, we've got the China ADR group that we generally focus on, the internet ETF for China KWeb, it's down, but emerging markets is up. So there is other stocks in there besides China. It's just that we just usually lump it in the China box. If you're curious or just, slightly nerd 101, you'd want to open that up and see what names in that are driving it to the upside. And bots is up. The rest of these aren't up enough. We would need more out of them. I don't think this rally day can be sustained by precious metals and solar, right? We're going to need more than that. So it can help hold the line, kind of stop us from getting a really nasty sell-off. but I just don't think it's going to provide that juice we need to get the breakout that we're looking for. 17% of the S&P is up at least 0.5% this morning. 13% is down 0.5%. That's really wishy-washy, right? There's nothing helpful there. If it was heavy one way or the other, that would provide more context and insight, but the same thing with the NASDAQ. 22% of the NASDAQ is down 0.5%. That's not very much. So kind of wishy-washy again, not really helpful. And 20% is up 0.5%. So that's not useful either. Now, you can focus on this different ways, but if you want to use this, I still like using 100s. So, like the NASDAQ 100 or the S&P 100 is the better way to go. Set that to 100. Use the market cap to keep the size of the boxes equal to the market cap instead of something else. Put this on pre-market change percent. By default, I think it runs 0.5%. So if it's less than 0.5, it'll just be gray. But if it's moved more than 0.5% up or down, then you start getting the color changes. So it's a nice way to visualize what's going on. You can see the Mag 7 by the size of the boxes, and you kind of get a feel for what's it look like out there. When I was newer to trading, I thought that these heat maps were the stupidest thing I'd ever seen. I just didn't understand them, and I didn't see their value. But do this for a while, and you'll really start to grow to like these. I think you just have to try them out, give them a shot. There's a lot of information here that you can take in without squinting at a watch list. So it's not that bullish out there. It's not that bearish out there. And if we get a move today in the indexes at this point, it doesn't look like it's going to come from equities. It's going to have to come from something else. So dollar, bond, treasury, yield, commodities, something, but this isn't going to get it done. All right, let's wrap it up. It's really simple, as it always is. GTFO, you got to get out of the box. This is our box. I want to warn, we could spend all day inside that little range. It's really unlikely that we do that, but price can do whatever the hell it wants, right? So we could just sit right there in that little range, and that would be a horrible trading day. It'll be choppy and violent and nasty, and you won't have any really good tradable opportunities. If and when we get out of that range, then the target is the edge, right? The edge would be either yesterday's low or yesterday's RTH high. There's plenty of other targets in between these levels that I've given throughout this morning briefing. You can focus on those, but that's your bigger picture target, right? Your broader perspective. It's a really simple trading day. The only thing that makes it kind of is that we're inside yesterday's price action, which is also inside of Monday's price action, and Fridays and Thursdays. And what happens when you spend that much time is you start to get price that looks like that. I'm not really interested in trading that, right? But those reversals off of the edges were decent. I'll take those. All right, so it's a real simple day. Just get out of the box. Do that. You should have some decent trades. As long as we're in the box, it's very likely just going to get more and more choppy and violent and nasty. So a little bit of patience. That's what I got for you guys. Be careful.